When you stop working, you might have a variety of accounts available to fund your spending, but which accounts should you withdraw from first? For example, you might have pre-tax IRAs, you might have Roth accounts, and you might have joint or individual accounts. Just like with a good dessert tray, it's hard to know where to start. It turns out that how you spend from your retirement savings can have a big impact on your taxes and other costs. So that's what we'll talk about in the next couple of minutes here. We'll go over the different types of accounts and highlight some features as they apply to retirement income. Then we'll go through some scenarios. And as you walk through those scenarios, I think you'll start to develop a picture of what your retirement withdrawal strategy should look like. And if you get nothing else out of this video, hopefully you can ask yourself the question if there's a way to manage your pre-tax balances in a way that will help you. So why does this even matter? Why would you care? Well, let's look at an oversimplified example. And I want to stress that the actual numbers here don't matter nearly as much as the concepts. So you might have a lot more or a lot less money. You might have it in different places. The point here is to illustrate how different strategies, which we're going to discuss a little bit later, will affect your income. So we have a 60-year-old married couple here, about 1.3 million. That's 1 million in pre-tax IRA and 300,000 in a joint account. And by the way, the same concepts apply to single people as well. I didn't really spend any time developing an analysis here. I just kind of quickly looked at two scenarios. One is where you follow the conventional wisdom. That's what we're calling the current track. And that is where you spend down the taxable assets first, then get into the pre-tax assets or the IRA. The other one is just using big round numbers, again, not based on any analysis. I said, what if they withdraw $50,000 from the pre-tax IRA and spend it, as well as convert $50,000 per year? What's this going to look like? We want to be very careful here because you will often see comparisons and people might sell their services by promising a certain amount of savings. It's really hard, if not impossible, to quantify the exact benefit of these strategies. You have to predict the future and get it perfect, which nobody can do. But the idea is to at least say, are we in the right direction? In other words, is there a benefit to using one of these strategies? And is the amount meaningful enough to get your attention? Because if it's a tiny benefit, it might not be as interesting. If it's a bigger benefit, maybe it's worth more research. In this case, it looks like the couple would come out ahead by using this withdrawal strategy, and that's where they take some income earlier in life. And if things work out exactly as we assumed, which they won't, their withdrawal strategy would result in about $417,000 less in taxes compared to the current track. Now, you want to keep in mind the time value of money. So you say, well, I paid taxes earlier in the withdrawal strategy, and $1 that I pay out today hurts me a little bit more than $1 that I'm going to pay out in the future. So we can adjust this and say, well, let's make it an inflation adjusted comparison. And we still see a decent benefit here. In current dollars, about $156,000 of benefit. So I used just basic inflation to compare these two numbers. You could quibble with that and you could say, well, actually, I'm going to invest it and earn tons of money on it. And you might come up with different results, but that's what I did here. Either way, it looks like it might be a decent option for these people to look into. Taking a closer look at the strategy here, this was not on purpose. Again, I just grabbed those numbers out of thin air, but they end up coming in just below the 12 or 15% tax bracket during those heavy withdrawal and conversion years. So that looks like it's still probably reasonable for them. And if we look at how their Medicare premiums might be affected by this type of strategy, once again, we don't really see a problem here. They're not necessarily going to bump themselves up too high. And in fact, if one of them was to die early, they still wouldn't face that so-called widow's tax trap or have the surviving person fall into these Medicare surcharges. So without the withdrawal strategy, they do end up bumping above these levels and they have to pay a little bit extra each month. Another thing to think about here is the taxation of Social Security. So depending on your income, some or half or most of your Social Security might be included in your taxable income. So we've just projected the year 2040 here because that's going to be easy for me to remember when I switch. Their benefit being about 75K, let's call it, but only 25,000, 26,000 is included in their taxable income with this withdrawal strategy. If we go back to the current track and go to 2040, we have that same Social Security benefit, but quite a bit more is included in their taxable income. And that's part of what contributes to the tax savings. Not only can they maybe get money out while they're in low tax rates, manage those future required minimum distributions or RMDs, but they can also manage how much of their Social Security is going to be subject to taxation. So you can start to see why this matters. Again, I didn't talk too much about the RMD, but that's kind of the whole point, is that on their current track, they would have their taxable withdrawals increasing quite a bit, quite rapidly, and that's not so much a problem if they go with the withdrawal strategy. Now, those IRMA costs, those extra Medicare premiums they might have to pay, are not included in the tax calculation, but that's also a cost. So sometimes I will export some data and then figure out the present value of that as well. That's getting beyond what we want to talk about today. The point is, again, just basic concepts that different withdrawal strategies, where you choose to spend from, can have a big impact on your outcomes. So let's briefly review those different account types. Again, you might have pre-tax accounts, you might have Roth, and you might have taxable accounts or non-qualified accounts. The pre-tax accounts, of course, have money that went in before taxation. For most people, the majority of their retirement savings are in these pre-tax accounts. So that might include your traditional IRA, 401k, 403b, TSP, SEPs and Simples, etc. It is possible to have Roth money in those accounts as well, but for now, we're going to focus on the pre-tax side of things. That's where most people and their employers have been adding money. And by the way, this would also include lump sum pension benefits. Pre-tax accounts provide a tax benefit when you contribute. So as you add money to the account, you can reduce your taxable income in most cases. With less income, you generally owe less tax, and plus any earnings in the account grow tax deferred. So any dividends, interest, capital gains, etc., don't get reported on a 1099 each year. You generally just pay the taxes as you take the money out. And that brings us to the point that with retirement accounts, you typically pay taxes sooner or later, and with pre-tax accounts, you pay the taxes later. Those distributions from your pre-tax accounts are generally treated as ordinary income. So when you take that money out of a retirement account, it goes into your bank account, for example. That's when it counts as taxable income. And the more income you have, typically the more tax you pay. Now on to Roth accounts. These accounts can potentially provide tax-free income in retirement. So you don't get a tax break when you put money into the account, but all of your contributions plus the growth on top of it can potentially come out tax-free. That's if you satisfy all of the IRS requirements. You can build up Roth assets in Roth IRAs or Roth 401k, 403b, etc., possibly even SEPs and Simples in the future, but nobody's really doing that right now. Like pre-tax accounts, the growth inside of your Roth is also tax deferred and potentially tax-free. So you don't get taxed on the annual dividends and interest capital gains. These Roth dollars can really be helpful in retirement. So if you need to take a big distribution for maybe a new vehicle or a new roof or something like that, that's when Roth can come in handy. Or if you're coming up close to maybe going over one of those IRMA thresholds, but you need a little bit more money that year, maybe your Roth account is a decent place to look. Then we have taxable accounts. These don't have any kind of retirement benefits attached to them. They're just plain old accounts like an individual or a joint account. You can put in as much as you want each year. You can take money out whenever you want to, but you may face taxation. So each year, any earnings generated in the account, that might be interest, dividends, capital gains, those are going to be reported and you may have to pay taxes on those earnings. So which account should you spend from first? The fact is you may have a lot of control over your income, more than you had during your working years because you just earned income and couldn't do much about your W-2. You just give that to your tax preparer and your income was your income. But in retirement, if you have these different sources to pull from, you get to choose where to spend the money from, and you can kind of turn the dial on your income to some degree. The fact is that no video or article can tell you exactly what to do, but there probably is a better and a worse way to take income. So as we walk through these different scenarios, you're hopefully going to get an idea of where you should start to spend from first. The traditional view has been to spend your taxable assets first. So maybe spend down your bank account cash or your individual investment accounts, and then get to those pre-tax accounts, the tax-deferred accounts like a traditional IRA, and then reserve for last the Roth type dollars. Unfortunately, the conventional wisdom is not the best way for most people to go. So there is a method to the madness. It helps you to minimize your taxes during the early years, and that makes sense intuitively. A lot of people look at this and say, why would I pay taxes before I need to? Whenever you have the option, you might think it's best to keep your tax bill as low as possible, and your tax preparer might agree, and a lot of financial advisors publish information that says the same thing. Unfortunately, you can only put off taxes for so long, and each year is a window of opportunity where you might be able to take income in a relatively low rate. But if you don't do that and your pre-tax accounts just grow and grow, that could be problematic in the future. Now, it probably does make sense to preserve those Roth type assets for later. Maybe you want to pass those on to your heirs if that's your thing, or maybe you can just use them for large lump sum distributions or to prevent you from going above certain levels. That part makes sense, but the rest of it could use some improvement. The next method is pro-rata. So some people decide to take a portion of the money they need from each of their accounts each year instead of starting with one and then depleting it and then moving on to the next. And Fidelity has this example here where they say, if you go with the conventional wisdom, withdrawing one account at a time, you pay basically no or little taxes, then a lot of tax, and then no tax later. But if you go with a pro-rata account withdrawal strategy, you're going to basically smooth out your taxes. There's also some research from Michael Kitzes that talks about this, and he points out that it's better than some other strategies, but it might even be better to look at maybe partial Roth conversions, or you might accomplish the same thing by doing strategic withdrawals and just spending down that money. So the pro-rata strategy is not the worst strategy out there, but it probably causes you to spend your Roth money prematurely, and there might be better ways to do this. The best strategy is to look at taking income from the source that gives you the best outcome both today and tomorrow. So it's an acceptable outcome today and an acceptable outcome tomorrow, not just a free ride today. When you stop working, your income drops, and that's often a nice opportunity to start using some of that pre-tax money. This is especially true if you can do it before Social Security begins. Maybe you even delay Social Security as part of this strategy and before your RMDs begin. There are a couple of different ways to take income. One is to just withdraw money from those pre-tax accounts and spend it. The other is to do Roth conversions. And so you can decide on an amount of additional income you want to take, but you don't need to spend the money. So you convert that pre-tax money over to after-tax Roth type money. The rest of the growth is ideally tax-free. You can also sell assets in taxable accounts if that makes the most sense. There are a couple of strategies there to look into as well. So let's look at a couple of different scenarios, and these might or might not apply to you, but with each scenario, we'll talk about a strategy that might make sense. We talked about being in that low tax bracket. So if your income drops and you are able to take income in very low tax brackets, that's often a decent idea if you can prevent yourself from having to take income in higher brackets later in life. We also want to look at your deductions. Some people have so little income in retirement that they don't even meet their standard deduction, and that's kind of letting an opportunity go to waste. So if your income is that low that you have zero taxable income, you might consider increasing your income to at least the standard deduction, if not higher, to take a little bit of extra income in low brackets. Next, if you are concerned about required minimum distributions, those RMDs later in life, if you are worried that they might get out of hand and cause problems, then reducing the size of your pre-tax accounts might make sense. So you can start whittling away at the size of those pre-tax balances, and that'll have an impact later in life. If you're concerned about Medicare costs or maybe even increased means testing where a higher income will increasingly penalize you, that's when you also might want to consider these strategies where you take income early. By minimizing those RMDs, minimizing those pre-tax balances, you can reduce the chances of having to pay extra for medical care. We briefly touched on Social Security taxation. That's another one where you might be worried about increased means testing causing increased taxes. So as your income rises, you might worry that more and more of your Social Security becomes taxable. Well, you can potentially manage that by spending down those pre-tax balances. And today's income tax rates are relatively low. So if you think that might change and you want to take advantage of known rates today, perhaps it makes sense to take money out, pay taxes today so that you can avoid whatever happens later. There's no guarantee anything will happen, or we don't know if it'll be enough to matter, but it's something to think about. If you're married, you also want to look at the so-called widow's tax trap. So that's when one of you dies before the other, and the survivor goes through the rest of their life in a single tax filing bracket. So at lower income levels, they're going to be at higher income tax rates, more likely to have Social Security taxed, more likely to pay extra for Medicare. These are things you want to analyze and see if it makes sense to take action. That said, it may be the case that you want to keep your income as low as possible and not take income early. You want to just leave those pre-tax balances for later. One example of that is when you're trying to keep your income as low as possible for healthcare subsidies. Maybe you're getting ACA credits, maybe you're on a state program of some sort. You might be better off keeping your income low, or you might not. It just depends on the details. One other example is some big one-off expenses. So if you're already in a high tax bracket and something comes up, you need to spend a large chunk of money. Maybe you don't want to take all of that money out of your IRA, a pre-tax IRA, because that could cause you to get into a high tax bracket. So you might look to other sources like a taxable brokerage account or maybe even a Roth IRA. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.